Good evening, everyone. How's everybody doing?
Really good.
That's good. That's good. Just double checking. We have audio for everyone. Everybody can hear me clearly, right?
Yeah, well, I can hear you.
For now. So I put in the chat to start another 10 minutes, so that takes us up to 6:20. So hopefully the other person will join by then. Okay, good evening to everyone. Looks like this is who we have to start, and that's quite fine. We have a quorum. I trust everybody is doing well. So, are we all here? Hi, are we connected?
Yes, we're here.
Yes.
Okay, Jamie, Sharella, Chanel, and I imagine Ebony will chime in later. Okay, so a few things before we get started. Did everybody receive my email? I did have some technical challenges. I had sent that email to Ebony and Lanika, oh yes, and Teresa. And of course, that was a communication which gave some general highlights, overview of the coastal framework, and some helpful reading links along with the financial ratios. Did everybody receive that?
Yes, I received it from Miguel.
Yes.
Oh, Miguel?
Yes.
Okay, great. Okay. Next point, I reached out to Miguel regarding the exam and overall certification process. So your assignment is 40% and the exam is 60%. It'll be 60 multiple choice questions. And as I understand it, everyone has completed their assignments and it has been submitted for review and grading by Chartered Bank in Scotland. Is that correct? Hi.
Sorry. I just came back from the ladies. Can we start over? What happened while I was gone?
So I was going over the email that I sent, and so I was getting confirmation that everyone received that. And now I'm talking about
The one you sent?
I initially tried
the one with the
tried to send an email. However, due to my technical challenges, I'm understanding that Miguel forwarded it on my behalf.
Yes, we got that one.
So you got it, great. Now we're talking about the exams, the certification structure. So it's 40% the assignment and then 60% of the exam. The assignment should have already been completed by all of the risk management participants. Yeah?
Yep.
Are you speaking to everyone or is everyone?
Well, I know
it was completed, but I think our issue was the fact that it was due or issued prior to us even covering the investment related chapter. So that was our concern. Like we were completing an assignment which we didn't even go over. Like we didn't even go over the material.
Okay. So firstly, I do recall me intimating, I don't know if the other lecturers mentioned it, but your certification is not limited to the modules themselves. This is an executive level certification. Some of the minimum requirements would be that you are in fact working within the discipline or have some sufficiency of knowledge within the financial services industry, particularly in the context of the subject matter. So notwithstanding that you may not have received the module or we wouldn't have had an opportunity to go through it completely, it would not have impaired your ability to complete the assignment. Okay, so I'm just confirming that everyone did in fact complete it for those who are on the call. So Jamie, I've heard from Janelle and Sharella. Jamie, Ebony, you both completed it, correct?
Yes, that's correct.
Okay.
Hello? No, I didn't. I completed it, but didn't submit it yet. I wrote Miguel and I explained that I just came back.
Okay.
And didn't, so I should now submit it to him.
So let's have a conversation with Miguel because I've already advanced discussions with him to schedule the exam, which is my next point. So see how quickly offline you'll be able to have an opportunity to settle to have that completed.
Okay, because I also sent him a reminder to request previous recorded classes.
Sorry?
Were previous classes recorded?
They should have been recorded to the best of my knowledge. I know the sessions I've had with this group has been recorded. So to that aspect of the question, yes. Now, other modules, I'm not able to speak to that. But once you touch bases with Miguel, he should be able to assist you. Yeah, my principal view is let's see how quickly we can get that submitted because that's 40% of the certification grading. Now, onto the exam. The exam is worth 60%, and it will be 60 questions, all multiple choice. Your exam will be for 2 hours, and it will be administered at the Institute of Financial Services right at this on Victoria Avenue. And there will be 2 sessions to separate the group because of the accommodations at BIF. So 4 per group. And right now we are proposing 10 to 12 or 1 to 3 p.m. All right. I had asked Miguel to send some communications in that regard. And so if you haven't received that as yet, you will be receiving that shortly. Are there any questions from what I've said so far?
Oh, yes, I have a question. Why is it in June? Why is it in June?
You should be completed with module 6 by
way before then.
Well, actually, third week by third week of May.
Wait, hold on. How long this class is? I thought this was a 6-month class.
Okay, so we are completing module 3 today. We should finish module 4 in February. Module 5 will be in March. Module 6 would be in April. Then you will use May for a general review. Remember, we talked about a review session, or if you don't wish for a review session or in time period, you can accelerate that, which then gives you latitude to have examinations to sit by June.
That's crazy.
Right? And then, of course, barring no operational constraints with the lecturers, it could be earlier, or it could fall within the proposed time of June. At the moment, it's just a proposed time, and that can be subject to change, as I would mention, based on circumstances. If you would like for it to be earlier, I'm sure the Institute would have no objection if everyone comes together, all of the students come together and propose May. If that's what you would like to consider. But what I would say though is, given that it's a certification course and you want sufficient preparation time for review and digest of the material before going into it. And everyone's level of comfort is different. So I would suggest having a discussion with your fellow students, and if so, you may choose to write to Miguel for consideration of an earlier time outside of the proposed dates. Yes, and that time at the moment is June 11th.
Okay.
Yeah. All right, are there any other questions? Because I heard that there were a lot of questions. Or was it just that one? Everybody's fine? Sharella, Jamie, Ebony?
Yes, I'm
Yes,
good.
thank you.
Okay. So I sent you some communications regarding helpful reading and the coastal framework. Let's talk about it. Can someone give me an overview of the coastal framework as it relates to enterprise risk management? If you are speaking, your mics are on mute. Did anybody read it?
What was the question? You want us to overview what?
The COSO
A summary
framework.
on the COSO. I don't know. You mean the same thing you said with the key financial ratios? That right?
Yeah. Yeah.
Oh, it sounded weird when you said it. Okay, so it looks, when I started reading over it, it looks like it's just giving us the separation between what the business is divided by when it comes to shareholders, equity, assets, capital that we work, gross profit, stuff like that. How I guess this structure would divide everything, and then proportion everything. Proportion the different sections of the business and how they are measured and what they how much weight they hold behind them. That's what I got when I just read it. I still really didn't understand it too much. I mean, I got the definitions, but it was working capital times 100. So it was just am I supposed to use my own figures, or is this based on the financial statements of a company?
Right.
So that's it.
Mm-hmm. Yeah. Anybody else? Thank you, Janelle. And does anybody else have any viewpoint from their reading of the framework?
Yeah, good night, guys. I did skim it briefly, and I think what I normally, when I do go over some of the material, I tend to compare it to what we are currently doing in our day-to-day. And I looked at our enterprise, what it is, the risk management policy, and just trying to see any gaps that we may have. And I see that the focus here was just really, ensuring that business objectives are outlined, and just, actual strategies on how to ensure that they're being attained. And it's one thing to have a policy that's wordy, because our document is pretty heavy, but is it serving the purpose that's intended? So I wanted to do a read over again, but just words like risk appetite and everything, we have those there, but what does it mean for your particular company? An investment firm's appetite to risk will be will be different from, an offshore bank's appetite. So it's just understanding your business needs and your tolerance for the risks.
That was very helpful, Flora and Janelle. Thank you. Any other final comments before I really just give some opine on the matter? No? Okay. So the COSO framework really leverages the initial conversation that we had relative to Basel's principles, the three core pillars when we talked about pillar one. And it gives you a top-down appreciation on governance, operational soundness, when you consider a bank's or financial institution's overall strategy. So there's two elements to the strategy. The strategy is the overall goal, their mission, their purpose, their focus. And from an operational standpoint, then it goes into how it will identify, measure, assess, and control some of its key inherent risks. If you read further into it and did some of the research, it then takes you into the ISO 31000 standard. You are studying risk management, so you want to be familiar with some of the more relevant standards and conventions that are in fact applicable to the discipline. And so you want to utilize the framework in building your very own governance and operational procedural flow. So what that means is just that. You want your policies, you want your procedures to be both practical, realistic, aligned with the business purpose and interest of stakeholders. So the framework goes into the risk segmentation based on behavioral applications or attributes. So those attributes will be whether you have a risk acceptance attribute, risk neutral, or risk averse. And we talked about them in the last session. And these are your measures of tolerances. Your measures of tolerance should then align with some of the key risks identified within your organization through its risk taxonomy. So your risk taxonomy is going to be truly a listing of what you identify when you look at your business units, your departments and functional areas. What are those risks that are likely to occur in the normal course of business? So there's a bit of calibrated scoring that is explained in the ISO standard. They break down how risk is measured. And there is, of course, we talked about it, the measurement of risk, the treatment of risk, mitigation of risk, etc. These components must be firstly realistic, and they must be properly measured. They must be measured in the context of likelihood of occurrence and probability of occurrence to determine the overall impact to the business. Because risk is a measure of uncertainty. Risk is anything that can happen And risk is everywhere, but we have to focus on the risk that matters. And so the standards help you to build your risk IQ. In the case of a financial institution, reputational risk matters in the delivery of their credit products and services. They want to consider internal and external risk factors that may primarily, in fact, impact their bottom line, volume, velocity, volatility of credit growth, credit sustenance, and even the overall value fit for purpose in terms of credit. The financial institution may not necessarily be so concerned about other factors, even though they may be a risk. So risk from a taxonomy standpoint is parallel to the materiality. And so those persons who have been in assurance services, like auditing, would be more familiar with that term. So materiality is the degree of seriousness when I take into account the likelihood of something, of a risk event happening, the occurrence of a risk event happening. I calibrate what my net risk score is to then determine my overall materiality and impact. And what does this do? That calibrated score then helps you to measure or risk rate a segmentation on low, medium, or high. And it could drive policy changes, behavioral changes. It could result in the perhaps decentralization of functions, discontinuation of certain business segments. Ultimately, your risk assessment is the key tool that drives decision-making. So we classify it as risk-based decision-making. So there are some efficiency processes that financial institutions employ in the assessment of the risk. So what does this mean? What it means is you take into account the quantitative and the qualitative attributes to then ascertain your overall efficiencies. I would have provided you with the financial ratios. For the purposes of the exam, you would need to understand what do the ratios tell you from a quantitative and qualitative standpoint, largely qualitative. How do you interpret them to support effective, timely, and robust decision-making? Notice the emphasis on decision-making. I earlier spoke about the risk manager being a critical thinker. Critical thinking is a fundamental, and the frameworks all undergird the foundation of critical thinking, right? So some of the assessments, when we get into the final tier of Module 3, it looks at some of the analytics or statistical overview of efficiencies when it comes to an investment portfolio, or even when it comes to how you risk attribute the taxonomies when we think about the propinquity of the risk or the likelihood of it occurring, or how closely are we from the ebbs and flows in the normal course of business. So that's with the Monte Carlo simulation. And it looks at an efficiency distribution, taking into consideration your any standard deviation and mean measurement, and it gives you a calibrated risk view to help you to understand what is the most efficient frontier of your product, your service, or ultimately a group of portfolios so that you have a higher level or ROI. The ROI could be a dollar value ROI. It could be a service-related ROI. And when I say service-related ROI, that usually goes into what is the dollar value of my capital resource, my employees. I have staff who earn 10,000, 20,000, 50,000, 100,000. Am I getting dollar for dollar or value for dollar per resource hour, right? And there are technical examinations that can assist us with this process. Now today, and when I say today, in this operating era, we do have softwares that can in fact integrate a lot of the various factors, so you don't have to do these calculations manually, but you do have to be able to interpret what the results are, right? So I'll stop there for a moment to ask if anybody has any questions. Any questions so far? It's okay to say no.
Just one question. It may not be related in this particular section just yet, but I know you spoke about, decision making and the risk manager being a critical thinker. Do the roles ever cross over, and can there be a conflict of interest, particularly if the risk manager if the compliance officer assumes the risk management position?
So your first question, go over that again for me. You're asking if.
So when it comes to decision making and the risk manager, well, let's just deal with the title risk manager. I think my question has to do with governance and conflicts of interest. Can the compliance officer also be the risk manager? Can the CEO also be the risk manager? Or should it be an external party?
So this is one of those questions that you really have to assess the nature, size, and complexity of your operations. Now, typically, what we see in the industry today, and again, this is global, we've seen a natural convergence of the risk and compliance discipline.
Right.
Right? And it's been, some persons at an individual level hold the function, others based on the complexity of operations, they need to separate it because of the volume of work. Mm-hmm. But really, it's important to appreciate, and we went over this in the second class, where we talked about the effectiveness of the second line of defense. Compliance is a critical function at the second line of defense domain, both risk management and compliance. But let me focus on compliance for a moment. What we see demonstrated in our industry is more compliance administration.
Right.
There is a lot of gathering of customer information and just making sure that's up to date. The risk management element or the analysis or technical aspects of compliance come in where you are now able to not just risk segment, but appreciate your value add opportunities from a growth perspective, from how risk is distributed, geographical concentrations, behavioral concentration. There's so many elements from a technical standpoint in compliance that we really don't practice. What we practice is just, you know, keep it up to date and keep it in alignment with legislation, regulatory requirements, guidelines, best practices, and
okay.
I don't like to use that word best practices because, you know, it's an institution specific thing.
Okay.
The risk management discipline, however, is one where you are really at a critical view from an enterprise-wide perspective, because every domain has an interdependence to support the management of risk. So when the compliance officer is gathering data, you need to have a sufficient level of separation so that the data can be effectively assessed. A lot of the assessment is done within the risk posture.
Not the third line of defense though, like wouldn't the risk manager also can assume like that level, the third line of defense being like, you know, have an oversight, like an auditor?
It is. So I'm gonna get to that. So the important thing here to understand is compliance is about conformity with rules, regulations, and parameters that have been established by the board, governing bodies, regulators, industry practitioners, like the Clearing Bikes Association and other well-known professional bodies, right? They've established certain frameworks, certain parameters that we must operate in if we want to maintain compliance with the license, right? Maintain good standing. The risk manager is the aspect of the second line of defense that must operate with every business unit head, every department head, to understand how the risk is being measured in the attainment of business goals, while taking also into account some of the strategies. So you have a compliance framework, you have policies and procedures. So think about your policies and procedures as your operational structure. This is your framework. So compliance says you need to stay within these realms, right? And so please tell us if you fall out of these realms, right? Or out of these parameters. Risk management is there to not only understand that, appreciate that you are remaining within the framework or operating within the framework, but also working with the risk owners or department heads to understand what are some of the dynamics to improve efficiencies and effectiveness, right?
Yeah.
And look at, so what they also do is they look at, I'm looking at a process flow. I see we're currently using 10 steps. How can everyone will get in a meeting and say, oh, we're taking too long to serve customers, you know, staff costs are high, we have to work overtime. The point of the risk manager is not after the fact. It is during the normal course of business to work with first line of defense or department heads to understand how could we streamline this from 10 to 5, thereby creating cost savings, overall efficiency, and better customer service, both for the internal stakeholder and external stakeholder, right? Thereby creating greater investment value and return on assets, etc. Then so that's one element. The other element is, where do the opportunities lie? while taking into account emerging threats. So the risk management practitioner must be on the cutting edge. I need to be aware as to what are some of the global industries thinking. How is my operating environment likely to change within a month, 2 months, 3 months? And based on those changes, how do I need to make dynamic adjustments or be more agile within my work environment? How quickly do I need to update policies and procedures? How quickly? So in our first and second session, I talked about time to market and scale to market. So you use analytics, right? And going to all these conferences and the webinars, that's not just information, right? The information should translate to changes within your environment. So I'll give you an example. You have financial institutions globally that are operating contactless. They're highly automated. They're digitized. They are not customer facing, right? They use more digital interface with the customers. They have also, they don't offer 26 or 30 plus products. Some of the institutions have specialized to focus on 2 or 3 products that they do very well, right? So when we look at the Bahamas, what do we have? We still have this struggle of traditional banking. Customers want to stand on lines and while trying to also navigate COVID. So you're standing on lines, you're sitting in chairs outside for some banks, or you're standing under a tent 6 feet apart. The operating hours have not changed. When you increase the inconvenience, you have the customer impact complaining. So you have a customer-driven society when it should be more of a business and technology-driven. And so most persons would say, oh, my customer is my business. However, your customer needs to grow with you. Otherwise, you'll be left behind, right? And of course, we can go into that discussion because it could be very subjective at some point. But look at what we're doing even with technology. We're into more software now. We're into more cloud infrastructure for our core environment, our core operating environment. So we talk about BCPs, right? What is the point of having a BCP for climate risk in the Bahamas? When you have a hurricane, are you going to have your hot site in the Bahamas? No. Please help me to appreciate why. Why are some of the businesses still operating their hot sites here in the Bahamas? So it's like, oh, my hot site is in Freeport. Oh, you mean the island that is often hit by hurricane? Okay. So we need to broaden the horizon, right? I mean, of course, we have to consider cost optimization in many respects, but we got to think things through, right? Then there's even the fit for purpose when it comes to securitization and risk transfer on insurances. But inherently, to answer your question directly, there can be a conflict of interest in the function. And that's why it ideally, depending on the complexity of your operations, it should be separated, because risk operates in a gray space. Compliance operates in an absolute space. which means it's either right or wrong. Risk can say, based on the circumstances, right? I can apply practice, because what we've done in a previous circumstance, or we have precedents operationally at an industry level or globally, we have been able to adjust in this way. And so for the risk manager, you have to be able to communicate effectively in writing, because whenever there is a deviation from frameworks or parameters, it's important to document that, because those deviations are naturally going to perhaps transition into the actual adjustments to policies and procedures. So practices carried out for a very long time should actually become the normal course of business relative to your change in process flow. So to the third element of your question, yes, there is a natural transition from risk management or second line of defense into third line. The real difference is in the frequency of engagement. Internal audit usually, or external auditors usually have a specified scope, which means they're not looking at 100% coverage. They're giving reasonable assurance. They're often away from the engagement of any product or service, so they have to be independent, notwithstanding risk management is independent, but they're away from it. And so the level of frequency is much lower than the risk manager. The risk manager should be there side by side, day to day in the normal course of business. Ideally, in a perfect world, that's how it should work. The internal or external audit may come once a year. I would like to review the effectiveness of your control environment in the investments department, in your trading department, in your credit department, in your insurance delivery department. I'd like to assess that, right? And so they will agree on certain scopes of review. And often, here's the value add, often the scope is driven by the assessment, whether it's the self-assessment by first line of defense or second level assessment, validation or review process by second line of defense or the risk managers, right? And so where there are key or critical variances or deficiencies in the operating environment, or perhaps maybe new areas of opportunities, they will be assessed at the internal audit level or the external audit level, and they'll give their opine, their professional opine on the matter. So that's how it should really flow. What we have is a lot. I mean, I feel like I just need to have a session locally. We have so many compliance professionals calling themselves GRC. Please stop. You're not GRC, right? You are compliance professionals that have learned about risk management. And it's a nice, catchy combination of three disciplines. It's not the same. And I really wish compliance professionals in the Bahamas, from what I've seen, would stop doing that, because it creates the confusion. And hence the question, right? What is the true role? Are you a compliance professional? Are you a risk professional? Or are you a governance? What are you, right? So hence there's an inherent conflict of interest, because there are elements to each role, right? So we can go into that a little later, but does that help you answer the question a little bit?
Oh yeah, that certainly did. Thank you so much. Just taking some notes.
Yeah. So that's why what is going to be helpful is when you start to engage some level of reading and appreciation for the standards. Read the standards, okay? And it will really help you. So continuing on, let me just share my screen a little bit. Here we go. Okay. So in our previous session, we talked about the risk management process, that cyclical process from the identification of risk, the measurement of risk, the assessment, the control functions, and the monitoring, etc. And then we went into some of the tolerances, and of course, then we finished our last session really going into some of the psychological factors and constraints relative to different business typologies. So now we're continuing into looking at investment management to this extent. So of course, we know from the investment management point of view, it's really about ROI, right? The key factors here is looking at the uncertainty of future outcomes. One of the most important element of any risk management function is really and truly how you measure the uncertainty. We could do it by stress testing, reverse stress testing. You could do it by leveraging self-assessments, but you need to have an assessment, and it has a combination of different variables, right? Always use a control variable, because the control variable helps to sort of mitigate these anomalies that can happen, whether it's upside risk or downside risk, when we think about different elements impacting your business, right? So we talked about this. This is the Markowitz morning portfolio theory. And again, this is in the context of investment, risk management from the investment standpoint, right? But I'm also giving you some appreciation on the actual discipline, right? So we talked about the variances and probability of distributions, but when we get into an actual example, you'll actually appreciate it, right? So when we looked at unsystemic risk is the real risks by which you address it or mitigate it by diversification. So hence the Markowitz theory, the principle of it is diversification. How do you spread the risk over a period of time, taking into account your mean standard deviation? So standard deviation, how it deviates. This is your risk of error. And your mean is your level of return, right? So if we were to look at this question, what would be, in your view, a quick answer for this question? For which of the following portfolios cannot be efficient? If you know your standard deviation is the measure of error and your mean is the level of return, what would be your answer?
B.
Sorry? So I didn't hear. Hi. Was somebody speaking? Okay. Let's see, Chanel. Let's give it a shot. It's only 3 options.
Okay.
So 3 options.
Cannot be efficient. Could not be efficient. I would say C. I feel like it's too close. It's too close.
Okay.
Are you pointing at B? Is that what you're saying? It's B?
No. I'm just moving the arrow. So you're saying
okay.
This is 1%. This is a 1% difference. There's a 4% difference. And this is a -2, -4, -1.
Mm-hmm. And well, how I looked at it, I feel like it's not enough room to fair, like it's too close. It depends on how it's being. I don't know. That was just a guess.
So in all of the portfolios, the standard of error is in excess of the level of return.
Mm-hmm.
Right? So in portfolio, the standard of error or your measure of error is in excess of your level of return. So I have a 2% residual loss in portfolio A. I have a 4% residual loss in portfolio B. And I have a 1% portfolio loss in portfolio C.
Okay. That's not how I read that. But okay, I understand now.
Yeah. So naturally, portfolio B has a higher degree of residual loss, right? Now, when we think about the 2 portfolios, how can we optimize the portfolios? This is all the question has provided. Based on your knowledge of risk management thus far and investment management and just overall in financial services, right? What would be your view on how to optimize these portfolios? Ebony? Okay, let's go with Shirella. Give it a shot, guys. This is why we're here. Are we connected? Can everybody hear me?
Yeah, I can hear you. I know what everybody else. So let me just, since everybody kind of quiet, would you recommend, or if I'm close, would you recommend kind of dividing some of the mean with the others that are kind of succeeding, or would you create a D portfolio for the 4%?
Okay, so that's
or the the error percent.
Let's take a step back.
Okay.
Everybody knows the answer to this question. But what I find in our jurisdiction, if we don't sound smart, we don't answer the question, right? Now, the reason why I say we know the answer to this question, because it's a fundamental of risk management and risk distribution, which we always do. If we know, so I'll give you one example, right? Because it's not a technical response. If I know in portfolio C, I have a lower residual risk, right? Compared to the other portfolios. I could do a comparative analysis to understand why this portfolio succeeded compared to A and B, right? Then I could look at what is the opportunities relative to how the portfolios may have been established from an income or like the nature of investments within the portfolio. I don't necessarily need that in the question. I know that these are three different portfolios. Do they need, are these portfolios distributed by a risk segmentation? I may need to understand what are the risk profiles of every portfolio. And that may help me to understand why there was a higher residual risk when compared to the others. I may need to understand what life cycle, remember the investment life cycle that we talked about in our first and second session, but more particularly our second session. Where on the investment life cycle horizon or maturation of the portfolio did it lie? Is portfolio A in the short term? Is portfolio B in the medium term? Or is portfolio C in the long term? Right? What is the customer segmentation? What is the typology? Am I dealing more with individuals who are in their spending phase, who are in their investment phase and wealth gathering phase? Are there any cross-border considerations? Were there any collateralization across portfolio C more than portfolio A and B, right? So go ahead, Cheryl, I see your hand up.
Okay, so in saying that, I guess it's just us well, not us, but you have to look at the risk and the reward. So which one of these would be considered the risk then? Because we know that it's efficient, like you said, it's efficient if the returns are lower, right? Lower than the risk. So I guess for me, which one is the risk, the mean or the standard deviation? And then once we could do the comparison, then I think we can rule out which one is efficient.
Exactly. And this is an example of what you will be faced with on the job.
Mm-hmm.
You go into a meeting and there's very little information. There's very little information. And you need the voice in the room for a critical thinker. Sometimes the critical thinking is about defining the strategy. It's not about having the answer, right? And that's where the thought process should flow, right?
Mm-hmm.
So definitely, you know, a question like this can go into so many different elements, and you'll see that when you start to prepare for your exam, right? Some of your multiple choice questions, as you prepare, you need to answer the question and then reverse engineer the question to say, what would my question look like if another answer was the answer? right? We can get into that a little later, but this is how you really should begin the process of critical thinking and analysis. Like I said, you know the answer. It's just that you just have to have a level of confidence and belief in yourself to start the process of communicating that, right? And reading those articles and following those news on a regular basis, whichever level of frequency you'd like, they will help, right? So moving on, we talked about the efficiency frontier, and this is all about risk and return. When we think about capital allocation, a lot of these terms going into 3 and 4 and onward will really only sink in with the more reading that you do, right? So let's continue. So this goes into risk distribution. I talked about some of the dynamic elements of the risk rate trade-off. And so you'll see here, this talks about how there's an optimization of the portfolio. And so when you look at the risk-free asset based on volatility, when we talked about mean versus standard deviation, this is how some of the portfolios have been spread, right? And then this is how your customers look like. This is how your profit distribution looks like. It all depends on the nature of your business. And so the key here is, this is your dynamic frontier. Your dynamic frontier could be the structure of your strategy, your policy, your procedure. It's how, we talk about the alignment of interest within the quadrant. And so we have to bring the different variables that impact your operations in alignment. Hence, this is your dynamic point. Your dynamic point of efficiency is where your strategy lies. Hence, you need everyone within the business to carry out their function effectively at the best effort. We have some very exhaustive and well-written job descriptions in so many organizations. But I think for the most part, when you do a people risk assessment, you will find that many organizations across these job functions are executing less than 10% of their responsibilities and accountabilities, right? So let's move on. This goes into statistical calibration and analysis. This is nice, healthy reading. Unless someone has a question, I didn't want to go through those. Again, this goes into some of the analysis that is done. Like I said, this is done in most of the systems today. Everyone should be familiar to some extent with the bell curve. If they remember from statistics, the most favorite subject in college. And that is for your investment risk and risk posture review. Any questions so far? Are we connected? Hi. Can everybody hear me?
Yes, sorry, I was trying to speak. Could you just confirm the answer? The answer would have been B, right? Because it appears that it may be off of the curve. So was the answer B? Did I miss it?
Yes, the answer was B.
Okay.
Yeah. Any other questions?
Yes, I still lost. Like, question. What would be the answer for the second one when it comes to determining how we would manage or come at a risk point to create a solution for B? Because I still kind of got lost somewhere. Because I think we supposed to have more information or something. What?
I think the means are the returns, and standard deviation is the risk. And Mr. Williams, could you go back to that slide, please?
I so lost.
Okay, so let's work out the confusion.
Okay.
Okay, so let's slow walk this. Some confusion is attributed to your own expectation of what is right in front of you. What you need to do to build your risk posture is come to your problem with an open mind. What we did in the second element of the question is what we talked about is in the absence of no information, in the absence of completeness of data, all of the reports, all of the specialists in the room, we know that there is a lower residual risk when it comes to portfolio C, a medium residual risk when it comes to portfolio B, and well, a medium at A and then a higher one at B. So my question was, really, what are some of the thought process surrounding obtaining some level of efficiency? No, that's fine, right? So efficiency could mean understanding the risk level of every portfolio or the underlying investments within each portfolio. It could mean the time horizon. So first point, underlying investments. Portfolio C, because there's a lower risk, residual risk or risk of error, this may be a risk-averse portfolio of government fixed securities with perhaps maybe 10 or 15% of equities. And those equity investments experience some degree of unfavorable volatility. But the stabilization factor was the government fixed securities like BGRS, T-bills, T-notes, etc. Right? Yes?
Okay.
Portfolio
so would B, okay, continue.
Portfolio B may be a higher weighting of government, a higher weighting of equities when compared to government fixed securities. Because the appetite was more risk neutral. The appetite of the investors were more risk neutral. So they got all of the projections and they got all of the sensitivity analysis that says, in a year, based on historical performance, we've seen our equities move 10 and 12%. But we know that government fixed securities are going to remain on average 3 to 5%. And that remains stabilized. The more years at a higher level of maturity is when you would see the higher level of return, right? So you could consider that almost like a risk-free asset because of the government guarantees. However, you want to leverage more risk in the hopes of a greater return, but that didn't happen because it was only an estimate, it was only a projection. And that risk could have happened for several factors. It could be there was COVID. It could be there were major disruptions, and the disruptions could be the competitive landscapes. There was an insufficient amount of barriers to entry into that market. It could be that the product or service is no longer relevant or a viable product of return, right? So when
go
ahead.
So now that I kind of understand, so if I come across a question like this, my answer should, not to say it's an answer, but based on what you're saying, would be to, because it's such a big question, would be to address like the movement of the portfolios, and that way we could assess how to close or to bring down the error. Is that kind of what you're meaning? Before saying,
you could look at
okay.
it like, but remember now, you have to appreciate the thought process here. The thought process is Basel Pillar 1, Basel Principles, Pillar 1, the strategy, right? Understand the strategy. Is it long-term, medium, or short-term? Is the strategy about, it's not about reducing the risk, because some individuals, some investors, some stakeholders are willing to accept the risk. And the longer your time horizon, the more risk you undertake. And you incur more risk really due to greater level of uncertainty, right? So it's about how do you distribute or manage the risk within any portfolio. Efficiency is a measure of the grouping of those investors within this portfolio. And we're only talking about this because we're really talking about investment management. I accept that in the first 3 months of performance, I lost 2% because I am playing the long game. I accept it because I understand what happened in the market. I also accept it because the monies I invested, I was willing to lose. You see where I'm coming from?
Yes, sir.
I also accept it because I have a sufficient level of risk transfer. I have insurance, I have some securitization, some type of collateral. I accept it. It's okay. But the real efficiency is learning now. Guess what? This is a market, this is a product, this is a service that I should no longer invest in. Perhaps given my age, perhaps given my availability of liquidity, it could be so many things. That's why risk management investing is not for everyone. And that's also why I said there will always be different levels and measures of uncertainty. You have to focus on the risk that matters. What matters to you? What matters to the group of investors and customers that you serve? What matters to your product service delivery? All right. So the emphasis of the question was really to drive the critical thinking. And the critical thinking while employing the principles of the discipline. Right? Any other questions with this? Because it wasn't about this question, so to speak. Any questions here?
No. Thank you.
Okay. So liquidity. All right, so tell me what you know about liquidity. Hi. Hello.
Is it the risk of not being able to meet your various financial obligations? I know when a good is liquid, it means that it's easily turned to cash. But when we speak of liquidity risk, I think it means not being able to meet your financial obligations.
That's true. My question is, what do we know about liquidity? Not liquidity risk. Liquidity, what does it mean?
Mr. Williams, liquidity would be where or how easy you can turn an asset into cash.
That's what I said.
Okay, that's one component. Let's go to level 2, level 3. Right? Remember, our theme is level up, right? So when I think about liquidity, I think about what?
Like investments, stocks that can easily be sold for cash.
Okay. Okay, those
Yes,
are some points.
I would add also that liquidity involves the trade-off between the price which an asset can be sold or how quickly it could be sold.
Okay. Okay. So in addition to what has been shared, right? Thank you all. In addition to what has been shared, liquidity is really about leveraging. It's about buoyancy of your dollar. It's about market power and influence. The ability to align your level of return or expected return when given a certain level of risk. We want our risk to be at an acceptable level. It should always be acceptable, right? That is the hope. But liquidity, I'm liquid. You recall when we were talking about the financial statements, I used the word agility. I'm agile. So I can shift in different markets because I am in a singular molecular context or structure. So you talked about conversion. I don't have to convert. Right? I am monostructured to maneuver and navigate accordingly. I think about corrosion when I engage cross-border activity based on valuation considerations, based on foreign exchange. I may lose my buying power. We talked about buoyancy. When there's a solvency issue, risk of default, I'm liquid. So liquidity is really your, and you got to think about it from the risk manager point of view. I have the ability to navigate uncertainty because I have an agile financial structure. My architecture is liquid. It's very fluid. So when you go into the risk now is about all of the elements that can cause corrosion of your financial statements from your assets. So you talked about converting, right? We know Basel talks about meeting obligations to unacceptable losses, which are some contingent events. And what is central bank's liquidity ratio standard, right? What is that rate? Hi. Does anybody know the rate? The minimum liquidity ratio required by the central bank?
Sorry, 20%.
I see something in the chat. Okay. Okay. But why is it 20%? Does anybody know why it's 20%? Well, some of the very obvious reasons is that you want to use the residual aspects of the liquidity in the normal cost of business to support really the engagement of customer service, product service delivery, right? And so we have to appreciate fundamental elements relative to liquidity. And these are all healthy reading, right? The objective is not to go through the slides. The objective is to teach you the concepts. We will be able to learn the concepts a little better once you digest the slides, right? So we talked about the 3-pillar framework, and we understand how liquidity comes into effect. So when we go into the strategy, again, we're able to support capital adequacy, stress testing, and manage liquidity risk in the context of the sensitivity relative to the 3 core domains in the pillar 1, credit risk, ops risk, and market risk, right? Then the principles of liquidity really, these are principles that look at how contingent events are measured. And it's about really, you want to demonstrate sufficiency of the cushion, right? You'll notice the verbiage, a cushion of unencumbered high quality liquid assets to withstand a range of stress events, including those involved the loss or impairment of both unsecured and secure funding sources, right? For a risk management professional, it's about measuring or risk weighting your liquidity in the context of a beta of uncertainty. So you have to determine, again, how is your liquidity being measured? Are you measuring it according to your physical asset, your operating asset, your sales-driven asset, or your human infrastructure asset, right? And the principles go on that really talks about identifying, measuring, monitoring, and controlling it through that assessment. But you really have to have a strategy, right? One of the key things is securitization under Principle 9. And Principle 10 goes into stress testing. So this is your hypotheses, your critical analysis, whether it's institution-specific, industry-specific, customer-specific, market-specific. You have to consider the different scenarios and massage in different variables, which is going to help you with your liquidity risk. Now, a key focus when we look at Principle 11 is the contingency funding plan. So a lot of this comes into play with, so the regulator would be more familiar with this, and this is your ICAP, right? And you want to demonstrate how working capital and liquidity measures, all the ratios, hence I provide you with the financial ratios. You'll be able to demonstrate some robust risk management and soundness of the liquidity management, right? You want to look at those shortfalls. You want to look at what is any potential impairment in normal course of business and how you adjust your liquidity numbers. You want to use it to support strategy. As you have different portfolios, you have favorable variances across different portfolios, across classes of portfolios, you may want to leverage. Sorry, someone's asking a question?
Sorry, I got booted off.
Booted off, I don't know what that means. Okay, right. Okay. So again, the principles go into different discussion and digest relative to the soundness. At the end of the day, it's about effective corporate governance. It's about effective risk management, right? We talk about people, processes, systems, and these are the fundamentals, right? Some of the questions will look at different scenarios as to how you should measure liquidity. You want to appreciate the ratios. You want to appreciate what are some of the thought processes surrounding perhaps your strategy when you think about your customer segment, when you think about your investor segment, your earnings per share. I would have spoken to everyone about looking at the different stock exchanges and how they manage intraday activity and look at diversity of its risk taxonomy. And really, it goes back to the point of what we talked about on the potential conflicts of interest for a second, third line defense. How do each defense component effectively measure liquidity, right? So liquidity risk management has a lot to do with documentation, right? And what are some of the contingency protocols to restore liquidity? Most persons think about it as, okay, I have shares and I need to sell those shares to the market. But you may not necessarily have a market to sell to. You may have fixed income securities. There may be losses on conversion. So there are certain stakeholder consideration when we look at liquidity, right? So we talked about those formulas, and you have those formulas in the ratios I provided. But this is it. This is the core slide here, right? High quality liquid assets, diversification. This is what is core from your risk management when we think about effective performance, internal controls, and overall governance and accountability. So you want to focus on that slide. And these are just some healthy examples as to how you can calculate. When we get into Basel III, it starts to talk about LCR and NSFR. There are some formulas on the central bank's website and even just in your usual internet search engines to support some of the emerging focus relative to the calculations. The other ratios you'd be able to see those in the email I would have provided you. So these are some of your HQLAs, some of which you are already familiar with. So that's healthy reading. And this is a very, very good point, right? You need to know what is the purpose of the net stable funding. Establishes the minimum acceptable amount of stable funding that must be put in place based on liquidity characteristics of a bank's assets and activities over a year. That's usually a question on the exam and how it's calculated. And again, this is some healthy reading for those that want to digest the subject matter. And that's it for module 3. And any questions? Is this a clap or is this a question? Hi. Okay, if there are no questions, I would encourage each of you to read the slides. Next week or a week after, we'll go into module 4. As I indicated, your reading will support the digest and understanding of the fundamentals. I will very likely send another communication to keep you guys abreast as to what some of your focus should be. In addition to the slides, please be reminded that you are not limited in scope to just the slides, but really you should read some of the frameworks and try to follow the discipline and best efforts, right? And with that, I bid you adieu. Have a good evening, everyone.
Thank you. Good night.
Thank you. Good night.
Hi, Mr. Williams.
Hi.
I'm sorry, I'm not sure. Did we receive this? Was this slide provided already? Not sure if I missed it.
Provided via email, is what you're saying?
Yes, to the class.
Yes, you should have received. I think Ebony sent it to you, or someone should have sent it.
Okay, I'll just ask Miguel for it. I didn't receive it.
Okay.
Thank you.
No problem.
Good night.